So I had a request to do a video on a company called Dutch Brothers. Now, this is a good friend of mine, and he's actually not really a growth investor, but wants me to take a look at it and give my 2 cents. So we're going to do that today. Hopefully you guys enjoy my dive in, and make sure to subscribe and smash that thumbs up. Let's get into Dutch Brothers. So I really don't know anything about this company. It has recently come on my radar as a growth stock to kind of take a look at here. Really like where the business model is going and think that there's a tremendous opportunity here. Now, I'm not calling it a Starbucks, but it basically can follow the same footsteps. So with a $4 billion market cap and recent sell-off, maybe there is an opportunity here, but let's dive into why. Now, this company is all about custom coffee, energy drinks, and other unique drinks as well. It's a franchisable business that really focuses on a drive-through type of business. And so now you can start seeing here that there's going to be fast turnover rates as far as customers go. If it becomes a popular brand that people like, we can see that they can turn over customers very quick here. Mobile applications are in place, so they are somewhat technology savvy. And they also have franchising opportunities along with brand opportunities to sell in stores. So we can start seeing that this is becoming some sort of flywheel here where once they get the customer on, there's millions of transactions that can take place with just one customer, whether it's going through the drive-thru, going to the local store and picking up some of your own Dutch Brothers, or possibly buying into the franchise and opening up your own business. Now, this company went public in 2001, September of 2001 to be exact, and we can see that in 2019, they were doing $238 million of revenue, and that revenue has absolutely skyrocketed in 2022, doing $739 million of revenue. And we can see that operating income is possibly close to going positive here. Now, this is going to be a company that's probably going to want to grow rapidly. Now that they IPO'd, it's all about getting public money and growing at a fast, rapid rate. And if we look at the trailing 12-month, as I stated, we can see that it is heading in the right direction. Operating income is going positive, roughly $29 million of positive operating income, and still having pretty significant growth on top line revenue. So we're going to start seeing fundamentals kick in with this stock. And what's nice about this is the fact that the stock has been selling off, but the fundamentals are actually getting a little bit stronger here, which is lending an opportunity to possibly sit back and get it at a good price where the risk versus reward may make sense here. So a few things I noticed when I was plugging in the numbers, and guys, this is why it's so important to physically plug in the numbers, because when you do that, you're actually going to get a story behind that. If somebody just gives you the answer to something, the answer trajectory is always going to be different. And so what I mean by that is if I just looked at the surface level, I would say this company is doing phenomenal. But when I started uncovering some things here, what we're realizing is they're taking on more debt every year. They're issuing more shares, and they're actually issuing more shares to raise capital. They're doing a capital raise, which now questions, okay, are the fundamentals truly going to be strong going forward? And that's where I'm going to say pump the brakes regardless of what numbers I give today, because I think I would wait until we see this company actually get closer to being a little bit more fundamentally strong here. So let's go over what my concern is. When we look at cash and cash equivalents sitting right around $20 million, and we scroll down to see what their total debt is, total debt went from $151 million to $625 million. Now, right off the bat, this is a $4 billion market cap on a company doing call it $800 million of revenue. Now all of a sudden has $625 million of debt. And my problem with all of this is we are actually heading into a tightening cycle. I think we're at an end of a cycle, to be quite honest with you, where we could be heading into a recession. So the fact that they need a capital raise, the fact they're taking on debt at a higher interest rate, and they're not a proven name yet, is definitely making me a little bit nervous overall. So this is making it already me believe that this is a higher risk investment than I originally thought when I was just looking at surface level things. But with that being said, there obviously is probably going to be a right price for this stock. Market sentiment actually has the stock pretty close to fairly value here. When we look at what experts expect, a lot of price projections are between $31 to roughly $37, and the stock sitting at $25 a share, which is telling me, there is not a tremendous amount of upside here. And there is some risk with this company. Now, stock analysis has them growing over 20% pretty consistently and doing right around 28 cents in 2024, which is giving it a PE ratio at 121. Now, I know this sounds ridiculous, but remember, this is a very small cap company. It's growing very fast. So for them to grow into their PE ratio actually doesn't take as much as some of these larger companies at 50 and $60 billion valuations that are trading at 50 and 60 PE ratios. So the PE ratio on this, I'm not too concerned with. What I'm concerned with is the debt that they're taking on, the fact that they're issuing shares. This is going to water down current investors. And now if they start watering down current investors and the fundamentals start deteriorating, it's a double headwind for this stock to go cheaper. And so it does look promising, but I also would say it looks like it could get cheaper here. Going from $20 million of EBITDA to $90 million of EBITDA. So tremendous top line growth. And we're seeing here earnings before interest, taxes, depreciation, and amortization is also growing in nicely. And so just to err on caution, what I'm personally doing is using 20% growth rates from years 1 through 3, 10% growth rates from years 3 through 6, and then 5% growth rates from 6 through 10. I obviously think over the next 10 years, they're going to be able to do this with how fast all the experts are thinking they're going to grow. As you saw earlier, stock analysis had them growing over 20% for the next 4 to 5 years. So clearly, a lot of people are confident that they're going to be able to do this. Now, to err on caution, I am going to put a share increase of 10% every year. This company is a very low float, and I imagine that's not going to stay the same. When I think about a lot of growth companies that issued a lot of shares, the first ones that come to mind are companies like AMD and recently companies like Palantir. There's multiple ways that you can dilute shareholders. It could be stock-based compensation, could be raising capital. So I'm going to err on caution and say because this float is so low, they're probably going to have a tremendous amount of issuance of shares, which is completely fine as long as the growth rate remains strong. We're seeing growth in EBITDA margins, and I think that's going to remain consistent. So I'm going to use 12%, 14%, and 16%. I tend to think that they're probably going to have better margins than most companies because they're not going to need as much staff and everything is drive-through speed. So when we look at an EV to EBITDA multiple, we can see that it's trading for 30 times EV to EBITDA, while industry standard sitting around a 10, 11 times EV to EBITDA. And actually, this is not as bad as I thought it was going to be. If this company can still remain high growth, obviously it's going to demand a higher multiple. I'm going to err on caution and meet in the middle around 15 multiple on EV to EBITDA. Just so you guys don't think I'm crazy, Starbucks trades at a 20 to almost 21 EV to EBITDA because of the premium brand, because of the growth, and because of the stability in the company. Does trade for a multiple that's a little bit higher than median. And so I think putting a 15 multiple on this stock is actually pretty solid. Basically getting between a $10 to $20 stock price for this company. Now there is a lot of risk with this company, definitely not going to deny that, but I tend to think that this one's actually interesting if you can get it in the teens. And really, we're not that far away from that happening. As you can see by the 1-year chart, the 52-week high in this company was $41, and the 52-week low is just around the corner as it hit a 52-week low of $24.64. So I technically need this to fall another 25 to 30%, and I think I would be pretty interested on taking a very small position and building into this one. Now, of course, this is just my opinion. You always have to speak to a professional before investing, but that's kind of my process here, guys. Hopefully you enjoyed Dutch Brothers. Definitely an interesting company with high growth, but there is some back-end problems here that we have to keep an eye on. So I don't think you necessarily need to rush to this one. As always, we will see you in the next one. Peace.